It is so good to be back. It is so good to be back. We're both in our respective homes after way too long of travel, after way too long of being apart. We are finally in our respective places, ready to springboard like no other and have a very productive 2025. We apologize for there being no episode on January 6th. We were both respectively busy doing stuff we most certainly did not prioritize, but that will not happen probably for a while. I hope everyone had a great 2024, a great new year, a great holiday season. I sure know I did. How about yourself, Rob?
It was good.
Once more, this is the Lone Star Capital Podcast. I am your host, Craig McGrouther, the Director of Business Development, alongside the CEO, co founder of the firm Lone Star Capital, the vertically integrated behemoth that we are with $750 million of assets under management, bringing you another quality episode of listening today for our Lone Star Capital Podcast. We're going to be talking about our 2025 predictions, our market outlook, kind of the latest and greatest of what's going on right now. So that's what's going to be mentioned. But before we get into that, I really want to share our referral rewards program once more. I know we don't really have any former sponsorships or anything like that, so we're going to be talking around book here. And we really just want to make sure that we can grow organically from our favorite people, which is you, the listeners, and our investors who listen to the show, or maybe those who listen that know people that might be a fit for us. Perhaps you're not ready to invest with us for getting to know us better, whatever it may be. Totally understand. But the referral rewards program, Rob, would you please be so kind to share the incentive for those who would refer us, someone who would work with us, and the stipulations?
Yes, for sure. So we've been incredibly lucky and grateful for all of our investors who have been referring their family and friends. So we finally want to actually reward them for doing so rather than just saying thank you and giving them a gift basket. And so with this referral reward program, we are offering our investors a $2,000 referral bonus, which can be paid in cash. It can be added to your investment amount on whatever deal you're investing in at the time for referring your friends and family to invest with us. Now, this is, of course, just a friendly referral. This is not a broker dealer thing. This is not a finder's fee. It doesn't matter how much the person invests. If you refer them and they become a client of ours, an investor of ours, then we'll pay the referral fee to our investor. So that's, again, $2,000. Now, a couple other features of our referral program is for 1031 exchanges. So I forget the number. I think you said it the other day. It's like 40, 50 million or something crazy of 1031 exchange business that we've done. So it's a huge part of our business. We get a lot of investors coming to us interested in 1031 exchanging into one of our opportunities. And we are one of the leading experts in the industry at doing this. So we offer actually a whopping $10,000 referral fee if you refer your friend who ends up 1031 exchanging, selling whatever property they own and then rolling those proceeds in with a deal with us. If you're wondering why the referral fee is so large for a 1031 exchange as compared to a regular investor, that is because our minimum investment amount for a 1031 exchange is $1 million. So if you're not familiar with 1031s, this is a process where an investor sells investment property. It could be a rental home, it could be a commercial building, and then they defer the capital gains taxes associated with the sale by actually rolling over the gains from that sale into another real estate opportunity. In this case, would be an opportunity managed by us. And the way that these things work is usually people 1031 exchange large amounts, which is why it's $1 million, $2 million, $5 million or more. And that's why we're willing to pay that whopping $10,000 referral fee. So keep that in the back of your mind in case you're looking to make an extra 10K and you've got a rich friend who's looking at potentially 1031 exchanging an investment property of theirs. And then finally, for all the fund managers listening, or for everyone listening who has a fund manager friend in mind, we are also paying a $5,000 referral fee if you refer a fund manager who ends up partnering with us. So that should be definitely a hot one. I think we've already gotten, I know you got somebody who referred someone to you yesterday or a couple of days ago. I've got someone who is talking to me about some referrals. So I think the fund manager one's going to be a hot one. So please.
I think they should all be hot ones, hopefully.
You're right. They should all be
We
hot
don't
ones.
discriminate where it comes. It's all green to me.
Well, here's the thing. They've all been hot ones. they've all been hot ones. Now we're just finally rewarding people for it and kind of
Yeah,
giving a little extra incentive.
for sure. I mean, we've been so lucky to organically get really some of our best clients, our best investors via the referral setup, just generally, which is the highest form of compliment you can pay someone is, hey, you should work with them. There's a lot of options in the marketplace, so we're very grateful for that. But now let's, put a little financial incentive out there. I want to also just remind the stipulation for all these people. So let's say you invest or refer us an LP, a 1031 exchange investor, and or a fund manager. It's not like, hey, we have a conversation here and then you get the dollars then. It has to be at closing after that person raised capital for us or invested with us or 1031 exchange with us. At that closing, they come into it. We will give you said incentive reward there. And then finally, on that note there as well, we can't already be in contact with them or talking with them, so unfortunately can't circumvent it that way. We have actually had people that have inbounded in their system though, but we weren't in contact with. But that counts because that engaged the conversation. It was that little push over the edge, some social proof, some reward there that really enabled the conversation to work out. So we will obviously include that. Maybe they're in our CRM, but we're not talking with them. We will be very ethical about this. And as Rob says, and so funny, and I will say too, we cannot wait. Like, we cannot wait to pay you, to give you that little bonus and bump because you are complimenting us. So help us, help you, help us, is what I like to say. But we're very grateful for all the people in 2024, 2023, and obviously before that who were so gracious to give us referrals. As mentioned, it is our mission, our driver to get as much organic business as possible here, and also to have people that we really, really like that already know, like, trust us to kind of work there. I think everyone knows someone if they're kind of investing in the alternative investment space anyways. They likely already know someone else who is probably also investing in deals like this. So if you're investing with us and you know someone else is investing in similar deals, then why wouldn't you just pass off that conversation to us? So I think it's a win-win-win for all parties involved.
Good deal.
Now on to the meat and potatoes of the show, which is our 2025 forecasting and predictions for the year. So, Rob, if you wouldn't mind getting that briefcase, I know you have your crystal ball in there, so you can pull it out. That'd be great. Maybe polish it off. Yes, that one right there. Perfect. There's
Speaking
the
of crystal
ball.
balls, I just got back to the office this morning after being away, so sorry for the noise that I'm going to cause here, but
Now, make sure you put the noise right next to the mic so it catches it more.
here's my crystal ball.
Yeah, perfect. Who gave you that?
I don't know. I have a gift on my desk from somebody, so I have to figure out who this is from. But maybe this is an ashtray or something. But this is my crystal ball.
That could be a cigar. That could be a ashtray for cigars. Yeah, most definitely.
Correct. So yeah, this is my crystal ball, as a matter of fact.
Yeah, too bad you can't smoke those in your apartment. I can smoke them at my house though if I want, because I'm an adult.
Well, adults can do whatever they want.
Well, not if they live in someone else's building, because I'm a homeowner.
Yes, I don't own a house, and I don't own a car.
I know. Austerity measures is all it says. Cool, but 2025 forecasting and predictions. So I guess let's just start with the market outlook and update. Do you want to share, or would you want me to share the Pens for Letter, which shows everyone the heinous and diabolical Treasury rates right now? Do you want to do the honors, or do you want me to?
I don't think we need to belabor the Treasury point. I mean, basically, just to set the stage, right? We're recording this on January 9, and Treasuries are in the mid fours, and they continue to be in the mid fours, which is not where people really wanted them to be or where they hoped them to be. And it's certainly where fixed rates are today is most certainly not in accordance with where the real estate market needs rates to be, right? So you have to have some spread between interest rates and cap rates in order for really there to be transaction activity and for there to be an attractive risk premium for people to actually want to buy real estate. And so those are your two parts of the equation. You've got cap rates and then you have interest rates. So you need the spread, and that spread obviously can come from interest rates going down or cap rates going up. So the problem that I think we have in the market is cap rates are sticky and they don't really want to go higher than where they are today. Now, maybe that will change, but that's the feeling that we have in the market. That's how we feel the winds are blowing. So what does that mean? That means that interest rates are going to have to be the thing that gives. So real estate is in an interesting situation where people are kind of waiting it out, right? Which is not a fun thing to do, and it's not an easy thing to do. But we were talking about this morning actually on the phone. And it's our Q4, or at least for sure December, was very dead. Obviously, December is a quiet month anyway for new activity because people are taking time off, brokers are off, people aren't launching new deals in December typically. So December was very quiet. So what does that
Well,
mean? That means
actually, can I cut you off and take it before that? It was actually even October is when the market started pricing in Donald Trump winning the presidency by treasuries going high. So we locked up the deal in September, Cortland Mascai, which we, of course, closed the week before Christmas. And we had that deal penciled about a 5.4% fixed rate interest rate, which was around the treasuries being at about, what, 3.5% roughly, plus or minus in that year, in that 7 year. And then all of a sudden they trickled up and up and up because the betting market, the treasury market was going up and up and up there. So with the volatility going up there, coupled with the election, coupled with now the treasury notes being where they are, every deal that may have gone on market in, call it October, November, December, really just got pushed all the way till January. And these are not, overnight transactions. These are long moving processes. The bidding process, the marketing process for these brokers typically take a month, to basically award the deal. And then it's another 2 months to 3 months for closing after that. So it's really, a third of the year is managed by, these, institutional middle market buildings getting traded and sold, right? And unfortunately, as you mentioned, cap rates are really slow lagging. So cap rates have not adjusted, but debt certainly has. So something's got to give there. So that's kind of the state of the market. There's just been no deal flow due to that. But sorry, I so rudely cut you off.
no, it's okay. That is actually helpful because it's more than December. This year we had the election in November, and then we had I can't call it, it's not even a Fed pivot. It was the market pivot. It was the market pricing in the Trump victory and therefore tariffs and higher inflation and things like that, which I think will prove to be ill-founded. But that is affecting the market today. So yeah, things are very slow. And here's the comment that I really wanted to hit on is a couple episodes ago we talked about our ambitions for 2025, and we want to buy $250 million of deals, and we want to get busy, we want to be ambitious, and so we're a young ambitious company. But the problem is we can't fight the market. We're the best thing that we could ever do, the best deal we could ever do is the decision to walk away from a bad deal. And right now there's a lot of bad deals, not necessarily a lot of bad deals. There's just an absence of good deals, which would force you, if you're desperate, to do any deal that's on the market, which is more likely to be bad than good. So that's something that's really important, and that we have to kind of pat ourselves in the back and console ourselves like, hey, it's okay to not do a deal right now. It's okay to be patient because you can't force it. And certainly right now, there isn't something, at least that we're seeing, just given how quiet the market is, that's worthy of forcing.
Yeah, I want to be clear on this as well, what good deal means. For us, since we're not an all cash buyer, a good deal has to be the marriage of the right deal to overpay for, essentially, because you're the one winning it, with a debt structure that actually makes plausible sense, where the numbers actually work. And unfortunately, there's just really not any opportunities where we can really get to the returns generated necessary to make it make sense. Plus, obviously we would ideally want to be fixed rate borrowers, but, we would float if the opportunity presented itself, but we just feel like the mismatch is just too high right now and it doesn't make sense. Also, the problem is too, a lot of sellers are looking around right now and are thinking, okay, well, why would I sell right now with debt like this? If I'm a believer that debt will come down, I'm not going to take millions of dollars in my purchase price out of my pocket and evaporate, equity or gains or the profit margin of that deal due to debt really cutting things down right now. So, I guess that begs the question, Rob, if you're a seller right now, like, who is selling? Is it someone who is a forced seller for a multitude of reasons, which you could discuss? Is it a seller who maybe bought their property, call it in 2021 or maybe 2019? They've crushed the business plan. They've done really well. They've held it, and maybe they're not selling at the top, but they're looking around like, heck, maybe I'm not selling at the top, but guess what? I'm not going to be buying at the top either, and they're going to take that win. You're like, what is the makeup of a seller right now?
Yeah, that's a great question. So far and away, the highest proportion of sellers are developers, people that own property that was built within the last few years. This is the most liquid part of the market. And the reason for that is developers are in the business of buying land, building property, and selling it. They're not in the business of holding that property. So they that's what they do. And so they're more willing to sell. And also the class A section of the market, so newer property that was built within the last 5 years, is the most liquid because there's also on the opposite side, there's the most demand. So you've got a lot of willing sellers and you've got a lot of willing buyers when it comes to this segment of the market. So that's where we are as far as transaction activity. The whole concept of forced sellers is definitely overblown because there's been very little of that. Not because there isn't distress, it's because distress takes a very long time to play out, and because distress often requires a bank. And that process of a bank getting involved takes a long time, right? Whether it be a foreclosure, whether it be a deed in lieu of foreclosure, whether it be a short sale or the lender basically forcing a sale. So those sorts of things take a long time. The reason why banks have to get involved in many of these distress situations is because actually the property's value is less than the loan basis. So basically the loan amount is greater than the property value, which means that the seller, if they sold the property, they would actually have to cut a check to the lender. So people are obviously reticent to do that. So that actually precludes, maybe not precludes, but it obviously is a big reason why people don't want to sell, and they'd rather kick the can down the road and avoid that situation for as long as possible. Similarly, lenders are in the same boat. They also want to kick the can down and delay that process as well because they don't want to recognize a potential loss on their books and get rating agencies looking through their books and having problems there. So they would rather also kick the can down the road on performing loans. So this is why you're not seeing a lot of Class C transactions that people have been calling for at this point now 2 years.
Very interesting. Yeah, that's a really good breakdown. The other kind of thoughts I have here is, where do we go from here? What does the year look like? Because due to the fact that Q4 was so slow, that the Q4 deals that you acquire are your Q1 closes. It's funny. I was looking back at my memories. I do use Snapchat, not to snap everyone, but because I like to look back at a year ago, 2 years ago, even 7 years ago. I've got just stuff stored there, right? It's kind of a fun thing that I do personally. I would delete it otherwise, but I like that feature. And I saw 2 years or last year, what did we have going on? We had two deals. We had Aspire and we had Cortland Copperleaf, now known as Preserve and now known as Regency Grove. We had two deals, which was about $50 million of business that we in fact closed basically in Q1 and bled to Q2 a touch, right? But those were acquisitions there, which is just super interesting to think about. These things move very slowly. They move very slowly. They move very slowly. We were on the right side of rate locking those and whatnot. But these things just take some time to work out, unfortunately. That's really the nature of this. So for 2025, it seems like, the first start might be a little bit slow. But what I find very interesting, Rob, and I'm sure you can appreciate this, naturally, new year, kind of have to bang the line, call the friends, the contacts, the capital partners, the investors right now. And what I find to be very interesting is essentially all the capital fund managers, people that we work with have no deals in the pipeline right now. People are also struggling to raise right now more than ever before, which is just kind of a sign of the times, which, is probably indicative of the fact that deals are probably looking really fresh and juicy, the year before, 24, this year 25, and likely for 26. So if you are an investor, you've been burned before, help yourself by catching the upswing this time around. But I find it to be very interesting how little deal flow there is, not just with us, but throughout the entire marketplace. We're getting more than ever right now a lot of capital allocators saying, hey, do you have room in your deals that closed the year before? Because they don't get paid to sit on capital. They've got to hit their preferred return buckets. They've got to make their investor dollars here. And if you can't find a place to park money, you're just sitting on it and you've got to pay out that pref there. So it's on your books still. So I found that to be very interesting. The other thing I found interesting too is we're getting a lot of emails right now from more joint venture equity groups, bigger institutions, if you will, that are trying to reach out to us to see what our deal flow looks like, to see if we're going to NMHC and Laguna Beach IMN, to which unfortunately we're not. We're going to be setting up Zoom meetings after the fact because we're going to zig when everyone else zags. That's what we're going to do. We're going to be a little more choicey with the conferences that we go to, which we will do a event outlook for 2025 on the show. Don't want to tip too much there, but just from an equity outreach perspective, we are getting messaged right now because we have been such active buyers the year before and the year before. You really look at 2020, 2021, really the back half of 2020, but I would say mostly 2021 and 2022 had way more trades and refinances than what would be normal from a historical perspective, which has led to what? Which has led to the lack thereof in 23, in 24, and likely 25. And 25 now, I would say, would have more trades, but due to the volatility in the debt market, it's just making things really challenging. So equity needs to find a home as well. There's all this money that's been talked about that's sitting on the sidelines. Well, it hasn't been deployed that much. So there's just a lot of capital and, quite frankly, not that many deals.
So to add on to that and to spill the beans a little bit, we are this year looking to expand into Phoenix, which is very exciting.
Let's go.
We're going to do so very patiently. We're going to do so very thoughtfully. But I've been studying the Phoenix market more intently now, obviously.
Yeah, just by talking to me.
And reading CoStar. And what CoStar tells me is that the peak of transaction volume in Phoenix was in basically the trailing 12 months from like 2022 into mid 2021. So that like 12-month period there was, I believe it was 19 billion in multifamily transactions.
And what was the number in 2024? It's scary.
3 billion, 3.5, I think.
So I'm no mathematician, but 3 times 6 is 18. So that is eight times less. Is my math right there?
6 times less.
6 times less, sorry. 6 times less. So yeah, I literally just said the equation. 6 times less than what was going on the years before. I mean, and as I mentioned here, like, I think it's not overhyped, but it's overstated. Just there was way more deals than what was normal in market during that little short blip of time, for obvious reasons, because debt was so crazy. People could realize gains. People get into fixed rate scenarios for a long time and be really healthy. Not everyone did that, but it really created the storm that we're in right now, which is there's just less deals going on now than there would be. And I think a lot of stuff going on right now is whoever is owning the real estate and with the debt is in the highest and best use state, meaning they own it and they can operate it for cheaper and do better than the next person could, which is basically creating a situation where not a lot of trades are being done.
Yeah, and of course people can sell on assumptions, but that doesn't automatically make it a good deal, because typically sellers selling on assumption, they want to get paid for the intrinsic value being transferred with the assumed debt. So anyway, we don't have to get sidetracked into that, but I bring that up because it's just, I think Phoenix is basically the poster child of what went on over the last few years, which is peak transaction volume, which basically reflected peak valuations. And unfortunately, when there's peak transaction volume, you're likely actually to do very poorly from a return perspective, because you're buying at the peak of the market, then interest rates went up, cash flow was hindered, if not eliminated, valuations are down. A lot of people over levered in that time. So that turned out actually to be a bad time to buy, which coincidentally is when everyone was buying, because there was 19 billion of deal volume. Now look at 2024, there was very few. Now you've got a cyclical bottom of transaction volume. So that means very few people are buying, very little capital is being deployed. And so basically there is less capital than there are deals. And so just simply by that supply and demand, those deals are better. So that is an exciting kind of way to simplify what has gone on. And I believe that 2025, we will see an uptick in transaction activity. So 2024 in Phoenix, just using Phoenix as an example, maybe was about 3.5 billion in transaction activity. And I think 2025 is going to look like maybe 6, maybe 7, maybe 8 even, I don't know. And so that's going to be a nice bump off the bottom. It's still going to be far away from the peak. Maybe eight's too much. Maybe call it six. So if you believe in that, which I don't think is a hard thing to imagine, that 2025 is going to be a more active year, and you follow the logic of transaction volume being inversely correlated to the quality of deal, then you would basically say that, okay, the best deals were bought in 2024, 2025 will still be a good year, but things are going to be picking up. So things are going to get more competitive. Things are going to get a little tighter. So I don't think people are missing the window by any means. A lot of people would rather catch the upswing rather than catch a falling knife. But that's what we're looking at. And I think there's a little bit of, when you look at it from that perspective, there's a little bit of urgency that needs to be applied to this market.
You're saying to get into Phoenix now, as opposed to maybe waiting a little bit longer when you feel more ready, perhaps? Am I understanding that thought correctly? Or can you extrapolate on the urgency perspective?
So that's a good clarification, because I'm just using Phoenix as an example to kind of paint the picture, because it's the most dramatic picture, so it's the easiest to understand. But when it actually comes to a market by market analysis, I actually don't agree with that. I actually think that you can perhaps wait a little bit longer. So other markets are going to bounce back sooner and faster than Phoenix because of the oversupply in Phoenix. And we can have another subsequent episode where we really dive into the dynamics of Phoenix as I get more educated and as we spend more time there and really look at some live deals. But there's other markets like Houston, which are bouncing back faster than Phoenix because they have less. Houston, has less supply. So I just think generally, from a macro perspective, there needs to be urgency. But when you look at a market by market, I would say that there's more time in Phoenix than there is in a market like Houston. With that being said, we're going to be buying in all parts of the cycle, so we're not going to miss the boat. But that's my kind of highlight about where we are in the market and where I think we're headed. It's just really interesting to look at this and think about these things, because there's disparate viewpoints. We're talking about this idea of the market bottoming in various ways, whether it be the peak of cap rates in 2024 and whatnot. But then I just read Jeremy Roll's annual letter. I don't know if you read that as well, but Jeremy Roll's basically calling for a recession in 2025, which I agree with. I think that we're going to see the economy slow down in 2025, but the economy is divorced or isn't directly correlated to the commercial real estate market. We could be experiencing a U.S. recession, but cap rates could compress, values could go up, NOI could even go up. I'm not saying it will, but these things don't go.
Of course they
hand in
can. Yeah, of course they can, because these are slow indicating, maneuvers. Like, we've felt the recession for a while. Announcing it might just be, hey, we're at the bottom, things could go up. Or, on our end, like, real estate's been experiencing it. Like in 2022, the stock market and tech experienced a recession, right? So real estate has kind of been slowly going down and down and down and down. And we could be at the bottom as we speak right now. I think you feel pretty confident of that. I mean, I think at some point in the first half of 2025, that feels highly likely when you factor all the supply that will probably start finally being delivered. We've gone through and shown that graph before, with basically showing the amount of deliveries going with the amount of new supply coming online. I believe that was basically the metric, but essentially it showed that, supply is kind of getting fleshed out this year. 2026, there's basically going to be no new building.
There will still be deliveries in 26, particularly limited, for the most overbuilt markets. It will still be an issue, but even Phoenix, which is one of the most built markets in the country, by the end of 2025, it's going to be a lot of that supply is going to be eaten up, and you're going to get back to normal. And at the end of the day, it's not just about how much supply there is. It's all about absorption rates. It's about how much supply there is relative to the demand, right? People have been building a lot in Phoenix for a while. People have been building a lot in Austin. The thing about those markets is more people have been moving there every day, and more jobs have been there. And so those apartments have been getting absorbed. So you have to look at it from a holistic supply and demand perspective. I want to transition to talk about strategies for 2025, outlook for 2025. So now I want to transition into talking about strategy for 2025. So I think the big strategy, unfortunately, and you teased this earlier, is floating rate debt. So you talked about zigging while others are zagging and whatnot. The unfortunate thing is, as long as interest rates stay high on the fixed rate side of things, stubbornly, I might add, in order to really make sense of a transaction, you have to float, because today you can float at a cost that is commensurate. Your starting rate will be commensurate with a fixed rate, if not cheaper. We're getting into that. If we're not there already, we're very close to where your starting interest rate on a floater is cheaper than locking in a fixed rate today for 5, 7, 10 years. Why is this significant? It's significant because two things. If your starting rate is lower on your floater today than on a fixed rate equivalent, that means that that agency loan is going to size better. You're going to get more dollar for dollar proceeds because your DSCR test is going to be better. If you don't know what I'm talking about, go back a few episodes, I don't know, 5, 10, 20 episodes, watch all of our podcasts to figure this out.
You should be.
You should know this.
Come on,
guys, you should know this.
It's level 1.
So when it comes to that, that's really significant when it comes to agency, because by and large, agency borrowers are DSCR constrained. That means that you are borrowing loan proceeds up to the amount of debt that the deal can support at a 1.25 coverage ratio, debt service coverage ratio. So if your starting rate on a floater is lower than on a fixed rate, then you're going to qualify for more loan proceeds and still have the same DSCR. So it's not necessarily that you're taking more risk by taking more proceeds. You are taking more risk from an LTV perspective, but from a debt service coverage ratio perspective, it's the same because you're sizing to the same constraint. Just one deal has more spread, more cushion, which inherently has more value. So that's significant. The other reason why this feature, meaning your starting rate today on a floater, is less than the fixed rate equivalent, the other reason why that's significant is because, guess what? The Fed is going to continue to cut rates. Now, of course, there's discourse about that. There's perhaps disagreement, but the consensus in the market is that the Fed is going to cut 75 basis points in 2025. Historically speaking, in a cutting cycle, the market underestimates how aggressively the Fed is going to cut. So I think the 75 basis point projection is conservative. It's not like bankers going crazy and getting high on their own supply. So what that means is you can start today floating at a lower rate than if you're to fix, and you will likely finish the year with an additional 75 basis points in savings above and beyond where you started from, which is above and beyond where you would lock your fixed rate. So those are the features of the market today. Unfortunately, like you said, we much prefer to be fixed rate borrowers, but really, for a deal to make sense and for you to optimize your capital structure, these two major factors are the factors as to why you should float today. So the reason why this is very interesting is because investing is not just numbers and math. Investing is emotional, it's psychological. And many investors have been burned by floating interest rates when they borrowed floating rates in 2020 and in 2021 and in 2022, because they borrowed when rates were low and then the Fed raised them and then they became high. The opposite dynamic occurred as to what we're seeing today, where you start floating here, you float down. People started floating here and they floated up. So,
well, can I also nuance it once more and just add to that? The other people that got burnt on the floating structure as well, where were the cap rates at? The cap rates were at, which is, reflecting on the valuation, they were in 3s. Okay, if you're, floating and you've got a cap rate, 5.5 or call it 5 to 6.5%, which is basically where cap rates have been, maybe adjusted with, exemption or not, it's a lot different of a scenario floating there as opposed to, floating at a 2 or a 3. So I just want to caveat that as well.
Absolutely. There's that factor. There's a lot of factors at play, but certainly valuations were more compressed, and also people were floating largely on bridge. So they weren't buying and financing based on in-place financials. They were financing upon future assumptions, which many turned out to be overly aggressive. So here's the thing. Investors have to really think about not letting themselves get burned twice by floating rate debt, right? Okay, you got burned, let's say in 2021 because you floated then. Well, don't let that experience burn you now by way of avoiding investing in a good deal today that happens to be floating, which is taking advantage of the best situation. So I give that advice, but the good news is the vast majority of investors aren't going to take that advice, which creates the opportunity to invest today in a contrarian manner, which creates better opportunity, better valuation. Because if everyone was on board with buying deals today with floating rate debt, that sentiment would bid up pricing. So pricing is staying lower because of the inability psychologically for many investors to overcome the hurdle of investing with floating rate debt today. That's a competitive advantage for those that are willing to do so. So I guess those are the three reasons which make investing in floating rate debt deals today, so long as they are bought judiciously, financed judiciously, responsibly, so long as those things are true, this is really the way to go. And as I say this, I'm really scared because number one, investing is hard and financing is difficult. But number two, even more importantly, the market has been so volatile. So as soon as I say these words, they could become untrue because rates could change, the Fed mandate could change, the economic conditions in the market could change. So just that's another thing I have to just preface that, we monitor this on a daily basis and we change our ideas on a daily basis.
Yeah, I mean, what's true today will not be tomorrow, perhaps, right? And you got to pivot quickly. So, super important to basically clarify that and to mention that it's not always the same. What will work today might not work tomorrow.
Yeah. So
So,
I
I
think,
guess my question for you then would be just for those who might be listening as they're kind of forecasting how they invest, where do we need to be for us to want to float? And where do we need to be from a debt perspective for us to want to fix? Does it matter per deal, per market? Like, how do you see that? Because it's not a one size fits all situation. If you get overly, all or nothing or rigid on your approach for an all or nothing perspective, you lose the nuance, which is where life is. So that said, where and what does it make sense?
so the 5-year US Treasury yield is at 4.47 today. So call it 4.5%. I think in order for it to be worth it to fix, I think you'd want to see the 5-year to be closer to 4%. So
Okay.
treasuries need to come down by 50 bips, I would say, to want to fix at
But
this
so
point.
as a holistic, like interest rate, like percentage, like, is that a 6% rate? Is that a 5.5 rate? Is that a 5.8% rate? Like what is like the actual percentage that you would feel good with? Like, because usually we're getting a lender spread of about 180. So what you're saying on that 5 to 7 year, we need to be basically sub 6% for you to feel good about it. Am I hearing you correctly?
That's a good way to look at it. Yeah, if you want to look at it from an all-in rate perspective, I would say that, yeah, spreads are somewhere in the high 100s. So if you're looking at, let's say, 180, like you said, a 400 or a 4% treasury plus a 1.8% lender spread would put you at an all-in rate of 5.8%. So I would say being somewhere around there is, in today's environment, would make sense to fix rather than float.
Awesome. So I think it's very safe to say 2023 and 2024, positive leverage, positive leverage, positive leverage. That's what everyone was saying. Do you think it'll be more of the same in 25, or do you think there'll be a new metric that people are going to look for there? What is the key item that people are going to be looking for? It could be the same. It could be cash flow. It could be left appreciation. We don't know, right? But if you had to pull out your crystal ashtray, what is it saying?
I think that people will still be pushing for positive leverage in 2025. I think people will abandon positive leverage when they become more sanguine, which is one of Howard Marks's favorite words, and it simply means positive in the face of difficult circumstances.
Who said sanguine? Totally off topic, but who said sanguine in a press conference?
No,
Aaron
but
Rodgers.
oh wow,
Yeah,
that's very ayahuasca of him.
I know. Colin Coward ripped him on it, but this is a total digression.
So yeah, people will abandon the positive leverage requirement for a few reasons. One, they will get more optimistic, they'll get more aggressive And so they'll be more willing to invest on compressed spreads. And number two, it's more appropriate or more palatable to invest in on less positive leverage or negative leverage when rent growth is higher, because it's very simple. If you might be buying at negative leverage today, which means a lower cap rate, but if rent growth is high and persistent, then you're going to quickly grow revenue to the point of having positive leverage. So over the last couple of years, we've had flat essentially to negative rent growth, which makes a lot of sense. Why? If you wanted to buy a deal a couple of years ago, you probably wanted positive leverage because you weren't going to go from negative to positive anytime soon. But when we hit that point of the market when all the supply has been built and absorbed, and now we're talking about a dearth of supply, and now we're talking about undersupply, and everyone's talking about how we have a housing shortage in America and how rents are
If
going
I had
up.
a dollar for every time I heard there's a housing shortage in this country, I would be our best LP. And that's saying something.
Well, people will talking about it more very soon, and when that happens, around, depending on the market, 2026 or so, there's going to be rent growth, and therefore people are going to be more willing to kind of skip out on the positive leverage requirement.
Fair enough. Yeah, I mean that would make sense. Okay, so that's your thought there, is that positive leverage will start to perhaps go away once supply is fully fleshed out and those
18 months.
fundamentals look like that. Okay, so 18 months, that will not be the theme, the super du jour.
Yeah.
Very good. Any other thoughts on your market outlook, or sorry, strategy outlook and update there?
No, let's leave it at that.
Cool. I guess just holistically speaking, cash on cash returns, total IRR. Obviously, it's very deal dependent. There's opportunities where, hey, a 12 IRR for, a really beautifully located new property would be a really good deal. And then similarly, a 20 IRR for maybe a more distressed situation could look like a good deal, right? We don't know what the market's going to bear and throw us. We want to be opportunistic and open minded with where we can create returns and generate alpha. But that said, what is the cash on cash we're kind of looking for? And then also, you have a really fun update with regard to the new distributions, or I guess not new distributions, but the way we're going to be doing distributions moving forward.
Sure. Cash on cash. So this is an interesting point, because the further away you get from cap rate or yield on cost, there's more variables, and therefore there's more nuance, right? The least amount of variable is, as far as equations go, is cap rate. Cap rate is basically income divided by price. That's a cap rate. How much manipulation can you do on that? Well, you actually can do some manipulation there. There's different cap rates. There's projected cap rate, stabilized, trailing, adjusted. What are you adjusting? So there is some manipulation there, but it's still a very simple formula. And then you look at cash on cash, there's more variables in cash on cash, because now you're talking about financing and you're talking about different timelines. Like, is it year one cash on cash, year two cash on cash? So there's more variables, therefore more nuance. So it's much more difficult, like you just alluded to put a definitive number on cash requirements or underwriting metrics, given the difference in deal types, right? You might be looking at a deal that's value add and therefore has less cash flow, or you might be buying a deal that's core plus and has more cash flow, or it could be dependent on the property's location and therefore risk premium. So it's difficult to say, but what I will say is I think that targeting somewhere for ideally a 7% average cash on cash over a 5-year hold period is very healthy. Another nuance as it relates to cash on cash, which is why it's so difficult to put a number on it, is interest only versus amortization. That really has nothing to do with how good a deal is, but it's one of the biggest impacts to cash flow. You could have fantastic cash flow because you opted to have interest only payments throughout the entire term of the deal, or you could have terrible cash flow because you actually assumed a loan, which is amortizing on a 27-year schedule because it had already been amortizing for 3 years. And you could be looking at almost no cash flow, but it's a very good deal. So those are the reasons why it's so nuanced. But generally speaking, 7% definitely, I think 5% in year one is the typical bogey, and that gets investors excited.
Excellent. Okay, now let's go to the final topic I think we want to mention today, which is events. I basically was a traveling circus last year. with regard to the amount of traveling that was done. It was crazy. I regret none of it. I wouldn't do it again probably, but you have to learn through trial and error as to where you want to go and not go. But that said, my travel schedule looks light. I think your year is in reverse for personal reasons and such. You'll be living my year of last year, which is traveling, being on the road probably more than you're going to be home, if I had to take a wild guess. But that said, conferences in 2025 will in fact look slightly different, even this month. So I remember, gosh, last year in January, I went to San Antonio with you and Houston. I remember you got sick, unfortunately. NMHC, Raise Fest. Well, not Raise Fest was in February, but it was NMHC. It was IMN Laguna Beach, and then it was San Antonio. This month, I'm not going anywhere. In fact, my first flight I'm taking is me to BEC. But just to round out the year, yes, it's a very lovely bobblehead that looks kind of like you. The hair looks at least looks
The
about
hair looks
like
very
you.
nice.
The hair is good. The hair is good. No one gypped you on the hairline. It'd be funny if they made you have a cul-de-sac or something like that. But at any rate, so far for the first half of the year, which is all we can speak to, or I guess we can only speak to about September, right? So I will be going to, and Rob will as well, we'll be going to Raise Fest, of which, Rob, you've got a headlining keynote speaking time, which will be super fun. So that's in February 20th, 22nd. We've got our Raise Fest event. And then I believe 2 weeks after that, we're going to BEC, which should be March 2nd to 5th. We'll be there. And then we will be hosting an event, I believe possibly in Austin, more of that to come. That's gonna be more of a fun manager oriented event. As I said, more details on that to come because we're still ironing that out. I think that'll be really special. So that'll be an invite only environment there. And then similarly, we're gonna be hosting a Lone Star West Summit event, which is gonna be super fun. In the heart of the Silicon Valley. More information on that to come as well. We'll get dates lined up here, but let's just go through so far. The first half of the year, we've got 4 events we're going to do. 4, count them 4. 1.
So the big
Raise
thing
Fest.
is, like you said, I will be rocking the stage, ha ha ha, again at Race Fest, which is why I'm bringing this bobblehead up, because Hunter so creatively
We love you, Hunter.
gave this bobblehead to me. So yeah, I'll be speaking about strategies for acquiring deals in 2025. So you heard a little bit about what we talked about today. So looking forward to being at that event, speaking at that event, and meeting with many of you. If you live in the Phoenix area or plan to travel to Phoenix for Raise Fest and attend Raise Fest.
Generally, like I live here, guys. So if you want to meet up, connect, I will take you to lunch. I'll even take you to play golf.
He'll even take you to play golf. So yeah, please reach out. We'd love to schedule a meeting. We'd love to talk with you at Raise Fest. So Raise Fest
and Raise Fest is a home game for us because Rob, it's one of his that's probably your tertiary city, the city you probably travel to the third most in the country. I would argue at this point, arguably, I would say the Bay, or I guess West Coast. I will say California, Arizona, and New York is where you're at most often. So that said, we're going to be having a home game. We're going to be hosting world-class dinners at my favorite places, the best restaurants in the city. So we're setting that up, and then we're going to be going to best ever conference. I think if I had to recommend really anyone to go to a conference, I think with all due respect to all of them, I think BEC is probably the best mesh of everything going on. So I think it's got pretty mass and wide appeal there. Would you maybe agree, or would you have a different take?
It depends what you want. It's very big. It's a very big show. So there's a lot of people there. So, excuse me, we're going to have a jam-packed calendar like we always do. So basically the strategy for you and I at these events is to pre-book meetings so that when we show up, we basically just find a table, we sit down, we have meetings all day.
We're dialed.
Very, very productive. And we get to meet new people, we get to reconnect with existing people, and then of course we take people to dinner as well, which is super fun and just another way to have a meeting, to connect, enjoy. So again, just another shout out. If you live in Salt Lake City or you are coming into Salt Lake City for the best ever conference, please reach out to us. We'll get a meeting on the books. We'll take you to lunch. We'll take you to dinner. Would love to meet you at Best Ever in Salt Lake City.
Absolutely. And then we have planted our flag. We're going to be doing an event of some sorts. I honestly don't even know what it looks like for our flagship Manhattan, Lone Star Summit there. Maybe the 5th one that we'll do. I don't know what it looks like moving forward. I don't know if Rob and Dosh have got something up their sleeve. They likely do. But that said, I got to run away mic here. That said, I believe that event will be on September
September
15th.
15th. Mm-hmm.
Yes, so September 15th, we'll be hosting that event there. It'll look similar but different. Always making little tweaks and iterations, but we're going to be hosting a Bay Area one because we've got so many great West Coast people. A lot of our investors really are actually out there. More of our LPs and some of our capital raisers live up and down the West Coast. So we would love to have something that's a little bit easier for them to access and get to, take care of people, host, do the thing. So we love to do that. And then also, we wanted to have less conferences intentionally to make it more of a strategic kind of travel place, for lack of better words. I'm kind of struggling to phrase this, elegantly. But that said, we're going to be traveling more to individuals, taking care of people in that regard, being more intentional with their time and travel. We've done all the conferences. Our model is not shifting entirely, but we've kind of feel like we've got a lot of our institutional friends pretty buttoned up, dialed in. It just kind of further, taking care of those relationships and fostering them. But we've got a lot of other new people that are emerging into the business that we want to meet with. A lot of our fun capital allocators and investors. We want to be with you guys a lot. So that's kind of why we're switching it up. Less institutional events, which is very exciting for me. Want to be a little more selfish in the time. I can be arguably more productive from my office here than I can be at an event. Naturally, it's also pretty expensive. Not that we really care about the expense perspective, but if I can be more productive from here and we don't have to spend extra money on flights, costs, and my energy, I think that's a win-win for all parties involved.
Yep. So if any of those events are of interest to you or are in your neck of the woods, please mark your calendar and please reach out to us. Like Craig said, there's going to be some changes happening to our LSC Summit that we host here in New York. So if you've attended in the past and would like to attend this year, or if you haven't attended before for various reasons, reach out to us because it's going to look different this year. So reach out. We've got special things going. So we would love to share that with you. And, of course, see if you're the right fit for what we have in mind.
Yeah, we're going to be honestly just unapologetically very selective with everything that we do, even more so moving forward. I think we're more confident in our identity and who we are. We know what works. We know what doesn't work. We're only getting better on that, but we want to make sure that we have the right room with the right crowd. And less is actually, in fact, more in many experiences. And that's kind of the approach that we're taking with who we want to be associating ourselves with in our personal lives and our professional lives. Keep the circle small, but not too small. There's always room for one more, as you like to say. So there's always room for one more if the fit's there. But we want to make sure that it's not far and wide and more of a curated environment.
Well, good deal. Well, that's an exciting year.
Any final thoughts for you?
No, I think that will do it.
Excellent. Well, if you have any needs, if you have any wants, if you have any questions from Lone Star Capital, please reach out to email me. If you're a fund manager, capital allocator, investor, have someone looking to do 1031 exchange, we'd love to pay a referral out to there. But if you're looking to make an investment, looking to kind of plan your 2025 investments with a group like us, we'd love to share with you what we're doing. For all those listening, we appreciate you, and we'll see you next week.